This video covers the Chapter 3 workbook solutions and corresponds to video 5 of my lecture series. For our first adjusting entry, let's look at prepaid insurance. On December 1st, Nelson Plumbing purchased a 6th-month insurance policy for $600. As of December 31st, 1 month of that coverage has expired. I'll show the original entry as well because doing so may help in building the adjusting entry. Our initial entry was a purchase of this prepaid insurance contract on December 1st. As always, it helps to analyze the transaction using the accounting equation. Is prepaid insurance an asset, a liability, or an equity item? It's an asset. Remember, it conveys that another entity, our insurance company in this case, owes us something, like insurance coverage for half a year. So in acquiring this prepaid, our assets increase. We're also paying out cash, an asset that is consequently decreasing. We'll increase our prepaid insurance with a debit and decrease our cash with a credit. Then post the entry to the respective T accounts. At year end, we need to book an adjusting entry. With December behind us, our insurance company no longer owes us all 6 months of coverage. Again, make use of the accounting equation if you need to. Prepaid insurance is an asset that we've just consumed. When we consume one of our own assets, we have an expense, which decreases equity. The consumption of our prepaid insurance asset constitutes a decrease in assets. To decrease our equity, we'll debit insurance expense, and to decrease our prepaid asset, we'll credit prepaid insurance. How do we figure out the dollar amount of our entry? If we take the $600 we paid for the prepaid insurance contract, and we divide it by the 6 months it will last, that tells us that it will expire at a rate of $100 per month. Then post to the T accounts. Insurance expense gets that debit to its left column, and prepaid insurance gets a credit to its right column. Tabulate the balance in prepaid insurance, and we see that we have a $500 debit balance, the amount of 5 months of coverage still owed to us by the insurance company. On December 5th, Nelson Plumbing purchased $250 in supplies. As of December 31st, only $50 worth of those supplies are left. With our original purchase, we increased assets for the supplies acquired, and we decreased assets for the cash dispersed. The increase in assets will be a debit to supplies, and the decrease will be a credit to cash. We then post these amounts to the respective ledger or T accounts. At the end of the period, we record our adjustment. At this point in time, we have $50 of supplies remaining. That amount is the debit balance we should have in the supplies after booking the adjusting entry. As for what's happening via this transaction, we've consumed some of our supplies, which is a decrease in assets. And when we consume an asset, we decrease equity with an expense. We record the expense with a debit and the supplies reduction with a credit. The amount is $200 because posting a credit of that amount to supplies will yield the desired ending balance of $50. Finally, post the supplies expense. On November 2nd, Wells Rental Properties received 3 months of rent, totaling $2,400 in advance for one of its commercial properties. As of December 31st, 2 months of rent has been earned. What's happening with this transaction? Wells Rental is receiving cash, which will increase assets. While Wells has received this cash, it has not yet earned it, so we can't increase equity with the revenue. Instead, Wells has an obligation to provide its tenant building occupancy over the next 3 months, so we increase our liabilities. To increase cash, we record a debit, and we record a credit to unearned revenue, our liability account, then post to the ledger accounts. At year-end, we need to adjust. Wells Rental has provided its tenant 2 months of the 3 months owed, so it's earned some of the money it received in advance, so equity is increasing. By earning a portion of the money, Wells has at least partially satisfied that obligation, so decrease liabilities. To decrease liabilities, debit unearned revenue, and credit rent revenue to reflect that this money has been earned. The amount of the journal entry is going to be $1,600. If $2,400 covers 3 months of rent, that means monthly rent is going to be $800. If Wells has earned 2 months for November and December, that means it's earned a total of $1,600. Then post to the T accounts. You'll see that the updated balance in unearned revenue becomes a $800 credit, the amount owed for the remaining 1 month. Accrued expenses. Assume that December 31st is a Wednesday. On that date, Wells Rental Properties owes $500 in wages to employees. These wages will be paid on Friday, the usual payday. Let's also presume these employees work a 5-day work week beginning on Monday. So if our employees earn $500 over 3 days, how much are they earning per day? $166.67. Now, let's examine the transaction. We've incurred this expense to our employees, which entails a reduction in equity via an expense. But we haven't paid them yet. As already stated, they'll get paid on Friday. In other words, right now we owe them this money, so we have an increase in our liabilities. For our decrease in equity, we'll debit wage expense, and to increase our liabilities, we'll credit wages payable. What's the amount of this entry? Our employees have not yet worked Thursday and Friday, so we don't owe them for those days just yet. We can't owe someone for something he or she hasn't yet done, so our amount will be the $500 stated in the question, and we'll post to our ledger accounts. On Friday, we'll book the entry to pay our employees. Going back to the equation, we're going to decrease our liabilities by paying what we owe and decrease our assets for the amount of money dispersed. The decrease in liabilities will be a debit to wages payable, and the decrease in assets will be a credit to cash. But these accounts are not the only ones involved. We've incurred 2 more days of labor expense for our employees, so we'll decrease equity again for that additional wage expense. As for the amounts, wages payable will be a debit for $500. We're paying off the amount owed. Once we post that amount to the ledger account, the new balance becomes 0, indicating that we're free of the obligation. Wages expense gets a debit of $333.34 for the 2 additional days worked after the start of the new year. The total cash credited will be $833.34. Our employees are being paid the $500 we owed them as of the end of Wednesday, and the $333 they've earned since Wednesday. Accrued revenues. Nelson Plumbing granted a customer additional time to pay an invoice. However, the customer must pay interest at a rate of 10% annually. At the end of the accounting period, the interest has accumulated to $80. This will be short and sweet. Nelson Plumbing has already completed the work to earn that money, so to increase equity via revenue account. Whenever we have a revenue, we're going to have a corresponding increase in assets. Nelson has earned the money, but it hasn't yet received it, so the asset we increase will be accounts receivable with a debit. Of course, the credit will go to fees earned. Easy enough. Now, just post to the T accounts. Depreciation. Daisy Florist purchases a delivery van for $12,000. The van will last for 3 years. Depreciation adjustments are really just another type of prepaid adjustment. When the cash outlay happened, we didn't record an expense. Instead, we moved that monetary amount to another asset account. Just like purchasing supplies with cash, we had an increase in one asset and a decrease in another. To decrease cash for the amount we paid out, we'll credit cash. And to increase the asset for what we acquired, we'll debit an equipment account for the van. At the end of the year, we need to adjust our accounts. The van won't last forever. Every time one of Daisy Florist's employees drive it, they're consuming some portion of the van's life. We need to record the consumption that occurred throughout the year. The use of the van will decrease Daisy's assets while also decreasing expense as what happens when assets are consumed. To record the expense, debit depreciation, but for how much? The van cost $12,000 and it'll only last for 3 years. That means Daisy Florist consumes it at a rate of $4,000 every year. Next, credit our asset, but we don't credit the van. We credit our contra asset account of accumulated depreciation. Remember how this information will be presented on the balance sheet. When you build the assets section, both the equipment account and accumulated depreciation will be included. As a contra asset, accumulated depreciation needs to be paired with its parent account on the balance sheet. Furthermore, since the contra account carries the opposite balance of the parent account, the two balances will net together. This difference is the net book value, or the unconsumed portion of the equipment. Sometimes you may see net book value presented in this manner. Putting net book value off to the side facilitates adding the net of depreciable assets with other categories of assets like current assets or intangibles, but we'll cover those later. This problem can be found on page 12 of your workbook. If you don't have it, you can pause this video and attempt the problem on a blank sheet of paper. I apologize that there's no space for writing journal entries. You may have to use the margin of your workbook. We're looking at Miller Company, which needs to make the following 3 adjusting journal entries. 1 for supplies used, 1 for fees earned but not billed, and 1 for depreciation on equipment. Regarding the adjusting entry for letter A, we adjust for supplies used by debiting supplies expense and crediting supplies. If supplies on hand totals to $10, that $10 is the balance we need to have in supplies after recording this entry, so we'll have to credit supplies for $70. Supplies expense gets the debit, bringing its balance to $70 since it had a $0 beginning balance. Next, we address fees earned but not billed. When we've earned the money, we need to credit a revenue account. fees earned in this instance. While we've earned the money, we've not yet received it. Our customer hasn't even received notification that he or she owes us, so there's no way we could have received the cash just yet. Since we haven't received the cash, but have a right to receive it in the future, we'll debit accounts receivable. The $55 debit and credit will bring AR to a $75 debit balance and fees earned to an $855 credit balance. Finally, we have our depreciation, estimated to be $20 for the year. Depreciation consists of a debit to depreciation expense and a credit to accumulated depreciation. Accumulated depreciation's balance rises to a $50 credit, and depreciation expense becomes a $20 debit. Every account that wasn't impacted by these adjusting entries keeps its previous balance. Finally, if we sum the total debits and credits of our adjusted balances, we see that they equal each other. You can also reconstruct adjusting entries from the unadjusted and adjusted trial balances. At the bottom of page 12, you'll see such information for Beta Company. Depending on when you're watching this video, there may be some errors in this section that need to be corrected before we begin. First, the owner's capital and owner's drawings balances. Cross those out and change them to $530 and $30 respectively. While not necessary to solve this problem, if you want to be a completionist, the totals also need to be revised. So let's change them to $11,230 and $11,360 respectively. Now we can begin, or if you like, you can pause the video and see if you can deduce the 5 adjusting entries that were booked from these balances. The easiest way to solve this problem is to move down the rows. Starting with cash, we see the balances didn't change, so no adjusting entry was booked. Just as well, if you remember from the lecture, adjusting entries will never impact cash. Same with accounts receivable. The balances did not change, meaning no entry was booked. We come to supplies, and we see the balances did change from a $200 debit to a $140 debit. That tells us that supplies must have been credited for $60. If our journal entry has a $60 credit, it must have a corresponding debit, or debits that sum to $60. When we adjust for supplies consumed during the period, what account do we debit? Supplies expense. If you look down, you'll see this account went from a $0 debit to a $60 debit, corroborating the debit of our journal entry. We see a similar effect in prepaid insurance. Prepaid insurance went from a $400 debit to a $210 debit, meaning it must have been credited for $190. When we credit prepaid insurance, we do so because we've consumed a portion of this asset, which means the corresponding debit for $190 must have gone to insurance expense. Again, if you look at the insurance expense account, you'll see that it went from 0 to 190, corroborating our entry. Accounts payable is fine, no change here. But wages payable went from a $0 credit to a $130 credit, meaning an adjusting entry must have been booked. The change tells us that wages payable was credited for $130. When we credit wages payable, the debit goes to wages expense. Look at wages expense on the trial balance. We see that the $7,200 debit increases by $130 to a $7,330 credit, or debit, excuse me. Unearned revenue is also changing, receiving a debit of $70. When we debit unearned revenue, the credit goes to fees earned. If you look at unearned revenue and fees earned, you see the $70 decrease and a $70 increase in fees earned. Owner's capital, owner's drawings, and rent expense did not change, so no adjusting entries were made to them. Now, the following isn't part of your workbook example, but I'd be remiss if I didn't cover it. Keep in mind that one account may be impacted by more than one adjusting entry. For example, imagine you were working through this example. It's nearly identical to the previous one. However, were we to work our way down the trial balance, recreating our adjusting entries, the first discrepancy we'd reconcile would be AR, which went from a $700 debit to a $740 debit, meaning it was debited for $40. When we debit AR in our adjusting entries, we're accruing for revenue we've earned but not yet received. So fees earned should be our credit. However, when we look at fees earned on the trial balance, we see that it was credited for $110, not $40. What happened is at least two adjusting entries credited fees earned. If we kept working down the list of accounts, we'd eventually hit unearned revenue, which received a debit of $70. When we reduce our unearned revenue liability, it's because we satisfied a portion of that obligation by doing the work, earning a portion of the cash that was paid in advance. So we credit fees earned. That $70 credit to fees earned here, combined with the $40 credit in the previous adjusting entry, yields that total $110 credit we observed on our trial balance. That's most everything covered in this chapter section of the workbook. I left a few problems for you to try on your own. I'll make the solutions available online. If you don't have it because you're not in my class, I thank you for watching this video anyways. I hope it brought some clarification and understanding of the material. Please leave any questions or comments below. I'll see you next time.